Alexander Darwall is the Chief Investment Officer and founder of newly established investment boutique Devon Equity Management, and he joins me now. Alexander, tell us a bit more about Devon Equity Management.
I set up Devon Equity Management with two colleagues from Jupiter, and what we're excited about is that we can have a really sharp investment focus. This means that Luca and I've worked with Luca for 12 years, can really focus on the investment side of things, and we don't have to worry about any of the management issues because Richard Pavry, with whom I've worked for 20 years, is running the business, and that really suits us well. So all the things that might be a distraction from investment have just fallen away, and Luca and I can just do what we enjoy doing, the investment side. It tells you something about what the idea is behind the model. What we want to do is to reproduce all the factors that made our franchise, our record, successful for the 24 years I was running money at Jupiter. And what I need to do that is I need lots of enthusiasm. Well, I've certainly got that now. We need a really good quality platform where it's got order management systems and a whole system that's geared up to help one thing and one thing only, and that is our investment performance. So we have that really good platform. Richard, together with our non-executive chairman, Simon Troughton, Simon being ex-chairman of Aberdeen and deputy chairman of Aberdeen Standard Life, is able to have a proper oversight. So we can focus on investment. We're based in Victoria. We're working in the same way. We've got excellent corporate access. And what we're doing for the next 2 years is focusing on really good investment performance. And we hope to repay all the confidence shown in us by those two core clients that came with us. My investment style is all about getting to know companies, to understand exactly how they make money, and then to select those companies that do something special and different. Those companies who can monetize that differentiation or that innovation they've got. That's what I enjoy doing. It means that we have a collection of 35 to 40 special companies where we really feel we've got an edge, and that more importantly, the company's got an edge. And where we find these great companies, we hang on. And that's why I've got some very old holdings that we know extremely well. And for as long as they are doing something special and different, we stick with them.
You've mentioned those two clients that you've got on board. So just to stress this, at this stage, you're not actually looking to expand the business.
Well, we might well have a very small institutional CCAV in the new year. We'll probably do that because we have an old client who's insistent that we provide some way for them to invest. But essentially, it's all about proving the business model, and proving it means we deliver good investment performance for our two loyal core clients.
Are you worried that this new venture is actually quite a lot of risk, stock-specific risk? I mean, your biggest holding, I think, is Wirecard, about 17% of the investment trust. It's had a bit of a torrid time.
Well, Wirecard's no longer 17%, and it's had a torrid time, so it's worth less than that now. Well, Wirecard, essentially, I've got wrong in two senses. One is clearly the share price performance has been disappointing, and I must apologise to people for having had too much in it, which is a fault I accept. But the board of the European Opportunities Trust is very comfortable with how we're going to work our way out of that. I've explained to them how we're going to work through this issue, but we won't have such a big holding in an individual stock again. Coming back to the problems with Wirecard is, I think Wirecard is a terrific company. I'm very confident about their business model. They fit what we look for. They do something special and different and better than other companies, and they can monetize it. So I'm extremely comfortable with the Wirecard investment. I might remind you, I invest in companies, not stocks. And the point about Wirecard is it's a great company. And if I continue to be correct in that work, and we understand Wirecard's a great company, we will get rewarded in the stock price in due course. All I need now is a bit of patience, and I'm sure we're going to do well.
In terms of the exact business it's in, it does, I think, internet payments, but why is that such a good long-term prospect?
The context for Wirecard's success is that e-commerce is growing. And more than e-commerce, there's greater complexity that comes with cross-border e-commerce. And Wirecard is the best in the world, in my opinion, at doing that. And there are a number of elements to that. First of all, they're both an acquirer and an issuer. And that in payments is very important. They're a full-service acquirer, which means that they take the banking risk of merchants defaulting. That's why they get a better margin. But they've been doing it for longer than other people. They were very early into the process of getting a banking license. So they have a different setup. They are more cross-border, much more international, more global. I mean, they are the only one who are successful in America and in China and everything in between. And by having both acquiring and issuing, they can provide a better service. So I think it's a better company in terms of addressing the big opportunity, which is the growing e-com opportunity.
What's more important to you, to buy a great company or a great management team?
Of course, we want both. But it is certainly the case that I look first at the industry and the specifics of that company. I typically look for a good industry structure and I look for a good ownership structure. That's to say, we look first for an industry landscape that means that a special company can emerge. It might be there are a very small number of players and there are reasons that people can't get into that industry. So I look first and foremost at the industry and the company. I do need to do business with the management, so I'm not going to back a management that I don't rate or I don't trust. But I will not go with just good management teams in bad businesses. We look at the good business first.
Given your growth investment style, what are the sectors that you typically tend to favour? I know you're a stock picker, and which are the sectors you typically tend to avoid?
Well, I'm never entirely comfortable with the distinction between growth and value because I'm an investor. I'm not a growth investor, I'm an investor. It is certainly the case I'm always looking for companies that share similar characteristics. And I'll tell you what those characteristics are, but these characteristics are found in companies across a number of sectors, and we like to have lots of geographic diversity, but also lots of business activity diversity within the portfolio. So we have a series of single company uncorrelated risks. In all cases, we're looking for companies that are run for the benefit of shareholders. That's a very important starting point and not true of every listed company. There are plenty of distractions for companies, but we want companies that are really fired up to help us. We look for companies who can have, in a sustainable way, some special attributes, innovation, business model, which they can then monetize. So typically, it is more likely we'll have companies with more intellectual property and less capex in the ground. So there's more IP and less capex. We have a lot of high margin digital type businesses and strong business models. So those are the kind of things that the areas, they are often the exception to the rule. And the rule would be very strong growth prospects with very strong margins will lead competitors to come in and erode those margins. And the exception to the rule is where that doesn't apply because the barriers to entry are too great, it's too difficult. Sometimes the regulator then comes in to erode those margins and that preeminent position. But again, we want the exception to the rule, the company that isn't vulnerable to the regulator. These companies exist, and those are the ones we back. So it's the exception to the rule across as many areas as we can find.
And when you're looking out at these companies into where their business might go in the future, how many years out are you looking?
I can't give you a specific time scale because the pace at which things fall into place to crystallize their opportunities is not something I can easily forecast. But what I do want is I need to get the right direction of travel. And I look first at the downside. Do we have a company whose franchise is strong and is not disrupted by the normal kind of trends that might disrupt? So if we look at technology developments or regulatory developments or consumer customer habits and behavior, is a company disrupted by that? And when we conclude that they're not vulnerable to those changes, then we turn it around and say, can they be winners from those changes? And where we find companies who are winners from those changes, typically I like to see multiple growth options. The more optionality, the better. In a simple terms, that might mean if we've got a strong business with a strong franchise where we feel that trends like digital and consumer behavior are following winds, they might take that model into new geographies. They might enhance the quality of what they're doing. They might address different consumer needs. So there I've just given you an example of 3 different growth options. So the more the better because, as you know, forecasting is the hardest thing.
But presumably companies like this are never cheap. There's others in the market that can spot them. What's the difference between paying what seems an expensive price today and something that you'll look back on in 10 years' time and think, that was a bargain?
You asked why we can understand things better than others, and I'm not sure we can, but perhaps some clues might be that we have total market coverage. Total market coverage is where we look at companies across the whole piece. We look at things we like, things we don't like, where we challenge our prejudices. And we can often get flakes of information and insight in weird and wonderful places that might apply in our mainstream investment process. So that total market coverage, I think, gives us better context and hints and potentially fragments of insight which can help the quality of our decision making. The second thing is I bring a lot of experience to it, and I hope the engagement with companies and management teams allows us to have a better quality interaction with companies who again can give us some insights that maybe others don't get because they're focused and looking at different areas. And I think the third aspect is with the quality of client base that we got, we can afford to be patient. It is always a huge mistake in investment to be in too much of a hurry. So we understand the world does not always develop in a smooth a way in the time that we want. But if we've got a good platform, a company with a great franchise, with the following wind of these positive trends and where we have a high degree of confidence, we will be patient and we will get rewarded if we're right.
You're describing a process that sounds very labour intensive. Can you provide all of that coverage when you're a boutique? It's you and one other fund manager. You haven't got the resources you had at Jupiter.
Well, it's true, I work hard, that's why I look like this. But at the same time, it's also true that I'm not doing anything different from what I've done before. This is absolutely a seamless transition. It's the same way of working with the same resources. I will employ an analyst to help us. That hasn't been high on the agenda because I haven't, frankly, needed it in the very short term with our move. But now we're in situ and it's all gone well. I can just give a bit of attention to getting the right analyst to do some data work for us. But you are right, it is labour intensive. That's why I work hard. But it's no different from what I've been doing for the last 24 years. It's exactly the same model which has been proved in the past.
You mentioned the importance of patience as an investor. How long can you be patient with a stock or a business until you think, actually, I got it wrong?
It's not usually a timing issue. It's usually facts which either convince me I got it right or, as you posit, I got it wrong. We deal in facts and developments, fact not fiction. So I can be patient because where we have really good situations, I don't know exactly when the good news is coming. But we will be patient up until that point. So we have, if the biggest problem we have is that a company is fallow, if you like, within the portfolio for longer than we would wish, that's not a big problem. The bigger problem is when business models go wrong. And I'm very happy to admit, and indeed on a number of occasions I have to admit, when I get it wrong, I'll tell you I get it wrong and we sell. And we have a good record of selling where we've got it wrong. But I'm very, very clear when I invest what exactly I expect of the company, what the strong characteristics of the company are, and the day we conclude we were wrong about that and that the proof, the facts show they didn't have pricing power or they weren't going to grow faster than whatever it might be, then we deal with that problem. We're bound to have mistakes because it's a difficult job. But it's not the mistakes, the first order of mistakes that worries me. It's if we don't deal with it, the second order mistake, did we deal with the problem? So where we have weak share prices, we always address it. And I'll tell you, and indeed I even write in the report and accounts, we got this one wrong. And in other cases, I'll say the share price is weak, but I don't believe we've got it wrong. This is an opportunity. So we will always give you a good view. And if we get it wrong, I'll tell you I got it wrong.
Who controls you? Who is there who can say no to you?
There's a lot of risk and compliance oversight. It works in many ways in different layers. And I'd say the first one is, the market itself challenges me every day. Every day I have a flow of news, which is both good and bad. So every day I have to be on my mettle and concerned. Luca, who I've worked with for 12 years, is very quick to challenge me, and that's what he's there for, and he challenges me. But in a more formal sense, we have a risk committee at Devon, and that's run by our CEO. So I have to conform with the terms of our mandates. We have an order management system that would block any kind of potential breach in the order management. On top of that, we have a non-executive chairman who again is very involved with the risk committee, who is there for oversight. Critically, in the case of institutional business, we have the board of European Opportunities Trust, who are forensic in their coverage of what we're doing. So there's that. We have compliance consultants and a seconded chief risk officer, as well as a chief compliance officer. And both our clients sent their own auditing teams in to check whether our compliance and order management systems were good. So I hope that's given you some assurances that there is a lot of risk and compliance oversight. There's no way I can go off piste, besides which I don't want to go off piste, because I've explained I enjoy doing this job, and this is absolutely in the slot of what I've always done, and we just keep doing the same thing.
Alexander Darwall, thank you very much.
Thank you.